Hello and welcome to this new video. Today we're going to talk about ETFs, one of the most powerful financial instruments for growing your capital with virtually zero risk. But what exactly are ETFs and how do they work? An ETF, which stands for Exchange Traded Fund, is an exchange-traded fund that can be bought and sold in the market just like regular stocks. Its goal is to replicate as closely as possible the performance, and therefore the return, of stock, bond or commodity indices. So you can buy a share of this ETF, just as if it were a stock in a company, so you buy a very small part of the whole basket that this ETF is replicating. For example, an ETF can follow the S&P 500 index, which is the U.S. stock market index that lists the 500 largest capitalization U.S. companies. Here's how it works, in simple terms. A financial company buys a basket of products, stocks, bonds, currencies, or commodity futures contracts, that make up the fund and then sells the stocks that follow the fund's value. The investment fund is managed by a manager who invests the money raised in buying and selling stocks by earning from obtaining dividends or reselling the holding when the value of the shares rises. The profit generated by the fund's investment activities is then redistributed to shareholder members to the extent that they have invested in the fund. They are called passively managed instruments because the manager aims to replicate the performance of a market rather than beat it. When you buy securities in an ETF, you do not actually end up owning a portion of the assets, unlike when you invest directly in stocks. The fund manager owns the assets and adjusts the number of securities in the ETF to try to keep their price in line with the value of the underlying assets or index. Let's now look at the types of ETFs you can buy. Indexed ETFs. These are aimed at tracking specific stock market indices. One of the most popular is the S&P 500 ETF Trust, SPY, which tracks the S&P 500 index. Foreign markets, country ETFs. Exposure to foreign markets is made easy by these ETFs. One example is the iShares MSCI Japan ETF, EWJ, which focuses on the Japanese stock market. Sector or industry ETFs. These ETFs specialize in a specific sector, such as pharmaceuticals, utilities, or technology. For example, the CRANS shares MSCI All China Healthcare Index ETF, KURE, focuses on the Chinese healthcare sector. Bond ETFs. These ETFs track different baskets of bonds. The iShares Core U.S. Aggregate Bond ETF, AGG, is one of the world's largest ETFs and offers exposure to a wide range of U.S. investment-grade bonds. Commodities ETF. This is the ETF that provides exposure to commodities, such as oil or precious metals. The iShares Commodities Select Strategy ETF, COMT, is a broad-based ETF that includes energy, metals, and agriculture. There are other commodity ETFs that focus exclusively on one type of commodity or a group of commodities. Currency ETFs. It is possible to find ETFs focused on the performance of individual currencies, such as the US dollar or the euro, against a basket of other currencies. You can also find ETFs such as the Wisdom Tree Emergency Currency Strategy Fund, CEW, which focuses on the appreciation of emerging market currencies. Cryptocurrency ETFs. A cryptocurrency ETF tracks the price of one or more tokens and consists of numerous virtual currencies. Cryptocurrency ETFs are typically the extended use case of blockchain technology. For example, a Bitcoin ETF is a fund that tracks the price of the world's most important and capitalized cryptocurrency, and allows investors to gain exposure to BTC price movements without having to actually own the cryptocurrency. Well, these are the types of ETFs you can decide to buy. Actually, there would be others as well, but these are the most important ones. Let us now take a look together at the pros and cons of this financial instrument. The main advantage of ETFs is diversification, which is one of the cornerstone principles of good investing. Aiming to build a diversified portfolio with a wide variety of assets and securities allows you to protect your capital. When some assets are losing, in fact, others should be performing better. However, before investing in ETFs, you should also consider the risks and possible downsides. Here, then, is a summary of the pros and cons of ETFs. The pros of ETFs are low-cost investments, immediate diversification, easy to buy and sell, high levels of transparency. The price updates in real time according to the performance of the components of the reference index, so the investor is constantly aware of the value of his or her ETF investment. Exposure to alternative asset classes. The cross of ETFs are, some ETFs may have lower liquidity, becoming more difficult to sell. ETFs can close, forcing you to sell an investment earlier than expected. Some ETFs have tracking error. Stock prices can deviate excessively from the prices of the underlying asset classes or indexes. Although you can trade them throughout the day, some trades may take longer to settle. Well, with this list of the pros and cons of ETFs, you have a complete view regarding this financial instrument. As mentioned, the ETF is a good instrument, not very expensive, and a differentiated financial product at its core such that it balances the risks of the investment. But it replicates a market index, so if the market goes bad, this negatively affects the performance of the index, and consequently, the ETF. Before buying an ETF, it is a good idea to evaluate its performance in recent years in comparison with the benchmark index and the cost of management. Thank you for watching this video. Click the like button if the video was useful to you and subscribe to our channel so you don't miss our new videos.